Hi everyone, I'm just going to be setting up the webinar first, so if you could just hold on for one moment while we can tweak the settings and make sure we've got everyone in. Great, I can see some people give me a wave. Fantastic. Now we get started today. So thanks for coming along today to our webinar series on JobKeeper. We presented on the topic last Friday, and that was just to give an outline of the rules and the legislation that came into effect. So today is really to talk about some of the amendments and the announcements that have happened since then. So this is very much a live question and answer session. We really want to make sure that we're addressing everyone's concerns throughout. So please, if you have any questions, feel free to submit them at any time throughout the webinar. Even if it's not relevant to the slide that we have presented, please make sure that you send through a question in the question and answer box. You should see at the bottom of your screen, you'll have a little icon that has Q&A, and you can submit any questions through there. If they are a little bit more complicated, just give me a bit of a wave or make a note and I can take you off mute and we can have a discussion about it. But we will try and get to every question we can. We want to try and keep this to about 30 minutes or under, because we understand that everyone's very busy. But if you've got a complicated question, then we're happy to speak to you after this and go through what our views are of the legislation and the rules. So after the webinar, I'll be sending through, this session is being recorded, I'll be sending through a copy of the recording so you can watch it again or pass it around, and I'll also be sending through the presentation slides. So today we've got a few different panellists with me. Firstly, I'm Sarah Capello. I'm one of the founding partners of Capello Rowe, and I've also got joining today Andrew Rowe, who's the other founding partner. Andrew, can you hear us?
Yeah, I can hear you.
We've got Joey, who's a lawyer in our Sydney office. Hi, Joe.
Hi, guys. And
we've got Laura from our Griffith office, who's a junior lawyer but a rising star. Hi, Laura.
Hi, everyone.
So today we're talking, as you know, if you're here, we're talking about the JobKeeper Act and rules. It was legislation that really gave effect to the government's announcement that they'll be giving $130 billion to Australian businesses, and the whole purpose of the Act is to make sure that Australians can stay in jobs. Now, it came into effect on the 9th of April, but since then there's been a few updates, and we're talking about that today. One is the alternative decline in turnover test, and the other one was an announcement that came out recently about service entities and a couple of other tweaks to the legislation. So it really is not a compulsory scheme. You can elect to participate. And it's important that people understand that even if you're eligible, you don't have to sign up to it. But once you do elect to sign up, there are some rules that you have to make sure you follow. There are some benefits in signing up, and we're not going to talk about them a lot today. We'll talk about some of the fair work rules that apply to employees. But really, one that we'll be talking about next week in our next webinar is the application of the mandatory code of conduct for commercial tenancies. So you have to be eligible for JobKeeper in order to actually, for the code to apply. So there are some benefits that flow from it. Oh, excuse me, my phone was on silent. So keep that in mind if you want to try and seek some rent relief from your landlord. So relevant dates and prescribed periods that you need to be aware of is the Act covers a period from the 1st of March to the 31st of December. But the JobKeeper payments are going to be available over a 6-month period, and they calculate based on fortnightly periods. I've got a question coming through already, so I'm going to address that. So this is from Jacinda. Being a sole trader, beauty therapist, I was told I was eligible. However, when I spoke to the lady at the ATO, she was unsure as I was not an employee of the business. And then I was also told as I have a second casual job, I was unable to get JobKeeper. Do you have any insight on this by chance? We definitely do. So the Act has provided, I'll talk about this at later slides, but I will answer this now. Even if you're a sole trader, you're entitled to apply for JobKeeper, and you can apply if you are not an employee as a business participant. So this means there are, I'll get to it a little bit later, but even if you're not an employee, if you show that you're managing the business and meet the other criteria, then you can certainly apply. What she might have been talking about with that second job is that you're only entitled to receive one payment. So if you have elected to receive it from your second employer, in your casual job, then you can't get it for your business. So it's very clear that individuals can only receive it once. So I'll talk about that again a little bit later, but in this instance, yes, you can definitely get it from either of your own business or from the second employer, but you have to elect one or the other. Then I've got a question from Rebecca. Do you think it's likely that the government will do a backflip on the 6-month period if the situation continues to stabilise? Well, that's a really good question. I don't think so, but I don't know if any of the other panellists have any ideas about whether they think there'll be a backflip. I haven't read anything about there being a backflip. Andrew, have you come across anything about?
No, I think it's highly unlikely because businesses will be, planning. They'll be planning their affairs in reliance upon this. So I think even in the best situation, even with the virus being brought under control, there's still going to be even the best case economic modelling shows that there's going to be a severe downturn as a result of this. So I think it's highly unlikely they'd seek to modify it now.
Yeah, I think I agree. And if you look back also at the mandatory code of conduct for the commercial tenancies, they contemplate a period plus a recovery period. So I think the government is very aware that there is going to be a period in due course where businesses are trying to recover from the impact from this. So I think it's highly unlikely. All right, just getting back to the periods, I hope I answered your question, Rebecca, and if not, just shoot through another question, or I can take you off mute and we can have a discussion. Applications opened on the 20th of April, and there was an important announcement recently that they extended the applications for the first fortnightly periods to allow businesses to apply up until the 31st of May. The important part of this, though, is you have to pay employees by 8 May in order to get the first 2 fortnightly periods. So it's really important to remember that this is a scheme where it's a reimbursement scheme. So the government is reimbursing businesses from the wages that they've paid their staff. So it's a very important deadline. They've been very clear. If you have not made the $1,500 payments to employees by 8 May, then you can not receive the payments for that period. You can still apply in subsequent periods, but not for the first 2 fortnightly periods. But that was an important announcement that came out relatively recently. So with the JobKeeper scheme, there are 4 key elements that you have to satisfy. The first is that the employer, so the entity, has to qualify for the scheme. The second is you have to have an eligible employee. The third is that you have to meet the wage condition, and that is to pay the $1,500 per fortnight. And this is irrespective of whether they've been stood down or not, or however many hours they work, you still have to pay the $1,500. And the fourth is that you have to notify the commissioner, and there are some reporting requirements to both the commissioner and to employees as you go throughout the scheme that it's really important to be aware of. So going to the first limb, when does the entity qualify for the scheme? Firstly, they have to be carrying on business as of the 1st of March 2020. There's some exceptions that I've listed there, and I won't go into detail there because I don't think it'll apply to this audience, but if you've got any questions, shoot them through. But with the second limb, that really is the most important part, and that's meeting the declining turnover test. So Andrew's going to be talking about the basic test and the alternative test.
Thank you. The requirement for a decline in turnover refers to the GST turnover of a business. I'll talk about that in a second. The requirement in turnover for most businesses is a 30% drop in turnover. For charities, it's 15%, and for businesses with a turnover of over $1 billion, it's 50%, but obviously for most businesses, it's 30%. The rules apply a basic test, and that basic test simply takes a comparison of GST turnover between the current period, be it a month or a quarter, and the corresponding period 12 months earlier. Now, the calendar months actually begin in March. The wording's a little bit confusing because it refers to a calendar month that ends after 30 March, but when you think about that closely, that includes March because March ends on the 31st of March. So you can take a month beginning from March, April, and so on, compare that with the corresponding month for the year before, or you can take the quarter, which is the quarter beginning 1 April or 1 July, and compare that with the same quarter the year before. So that's the basic test. And
Andrew, before you talk about the alternative test, I've got a question from Rebecca.
Yeah.
She's asked, as a sole trader or a business, you believe you qualified, but at a later date it was proven otherwise. What is the penalty, or is there no penalty, just a payback? So what I've read so far is that if there are any instances where there's a contrived scheme, then there's likely to be penalties, but otherwise it's just a payback. So Andrew, do you have any further?
Yeah, that's right. Look, what they look at, there are different consequences depending on the degree of culpability. And essentially, if it's an honest mistake, if you honestly believe that your projected turnover will meet the test, but it turns out it doesn't, effectively you're required to pay it back. But there are it does become more penal if there are circumstances where it's contrived, or you've tried to reshuffle your affairs to deliberately come within the limit.
But I recall specifically reading in the explanatory statement that there will be an element of discretion to it, in the sense that if you project a 30% decline, but it actually shows a 29% decline, that in those instances they're going to be, there's going to be a common sense approach to it. There's going to be some leniency to it. Whether that's actually going to come through, I don't know, but actually contemplated this occurring. But Andrew, if you want to get back to the alternative.
Yeah, so that's the basic test. Now, the rules contemplate that alternative tests can be applied as well. And last week, on the 23rd of April, there was a legislative instrument published which set out 7 alternative rules. And time doesn't permit for us to go through and analyse them all in detail, but I can just quickly summarise what these alternative tests are. The first one in section 6 deals with a situation where the business is a new business. So if the business is less than a year old and there is not a corresponding period a year earlier, then there are alternative rules for how the test is applied then. Secondly, in section 7, if there's a business acquisition, so if you've got a situation where a business, even though it's been running for more than a year, has made a substantial acquisition of another business, which has affected its turnover, then there are special rules dealing with that. If there is a business restructure, there are special rules dealing with that. If there has been a substantial increase in turnover for particular reasons that can be demonstrated, other than the 3 that I've just outlined, then there are special rules around that. There are special rules for drought or natural disaster affected businesses, and this is something which actually could be quite relevant to a lot of farms in this area. What the rules provide effectively is that a business which is drought affected and is in a drought declared area, for that business, the relevant comparison period can be the period before the drought, which in the present case is some years ago. So there could be quite a few situations where farms, they may think comparing this year's turnover against last year's turnover, they don't meet the test, but once they take into account the drought qualification, may find that they are able to compare it against a much earlier year.
I think the relevant takeaway from this new legislation about the alternative test is, if you, in the first instance, don't believe that you qualify, it is worth considering whether there are special circumstances that might allow you to fall into this, these special categories. So just turn your mind to some of these factors, if otherwise you don't meet the basic test.
Yeah, and the last 2 are if you've got an irregular turnover. So if it's a situation where you have a lot of fluctuation in your business and it fluctuates by more than 50%, then there are special rules that apply. And finally, if you're a sole trader or a small partnership and there has been an illness, so if it's a situation where you were ill or on leave for some other reason a year ago and that's put your figures out, then there are special rules that apply there. So it's worth keeping in mind that if the basic test doesn't apply, that one of these other alternatives ones may. Yeah. The last thing I was going to talk about, which I mentioned before, is the GST turnover. So the test is based on the concept of the GST turnover, which is effectively, what you put in your BAS return. That's the figure that is applied. But there is a particular complication. If you're a small business turning over $2 million or less, you may be accounting for GST on a cash basis rather than an accruals basis. What that means in practice is, the question in practice is, do you compare your cash receipts against your invoices? And the difference could be significant. And the answer is not entirely clear. At the moment, the legislation seems to imply that it is the amount invoiced that is the relevant comparison. But the tax office have suggested that if it's a business which accounts for GST on a cash basis, they would expect it to make the comparison based on a cash basis. So I think this is it is going to be a live issue for smaller businesses, and it's one where we don't know where it's going to fall. I expect there will soon be a tax ruling on it, but at the moment it is a bit of a question mark. So over to you, Sarah.
Thanks, Andrew. Paul's got a question in the chat. He's asked, if you are an independent contractor who has now got zero income since March 1, can you claim JobKeeper? So there's two parts of that question. Firstly is who is actually claiming JobKeeper? If you're an independent contractor and you operate your own ABN, then you can claim it under that entity. If there has been a decline and you otherwise meet the basic declining turnover test. And from what you've mentioned there, if there's zero income coming in, then you probably would satisfy that test. And you'd be able to obtain it on the basis that you're a business participant. If, however, you're trying to seek that payment from the entity that you contract to, then you are likely not going to achieve the test of being an eligible employee. And it depends upon, each case is different, depends upon the actual classification of the employee. So you're looking at independent contractor versus employee definition. But it's worthwhile looking into the structure. So broadly, hopefully I've answered your question, but it really depends upon some of the specific circumstances. And then I've got another question from Paul. What do you mean overseas revenue not counted? So this is for entities who trade internationally. They're only looking at the turnover of the business that's derived from their Australian sales. So you're not looking at any turnover. When you're determining a decline in income, decline in GST turnover, they're only calculating the revenue derived from the Australian sales. I've got another question coming from Jacinda. What about a small business that does not qualify for GST and falls under? If this is respect to GST turnover, Andrew, do you want to take this one?
Oh, look, yeah, my understanding of that is that it doesn't matter. It's effectively what your turnover would be if you were registered for GST. So it's not based on your actual GST claims, but what it would be if you had to put in a tax return. So if it's, my reading is that small businesses that are not registered for GST are still eligible.
You also need to look at the structure in terms of the sole trader aspect. So any other income you're deriving from other activities, so for example, your casual jobs, then that might be classified. But I understand that otherwise, if you're just looking at the income derived from the ABN, then it won't be. So you just need to be speaking to your accountant about how it's going to be calculated. An important note on this slide is that you only need to establish eligibility once. So this is very clear in the legislation and the explanatory statement as well, that as soon as you meet the test, you don't have to keep reapplying for it. So if in the month of April you can show a 30% decline on the basic test, and then in May you actually don't have a decline, you could even have an increase. It doesn't matter. You're still eligible to receive the payments for the entire 6-month period. Now we're going to be talking about recent changes that we've had, and I'm going to go over to Laura, who's going to be talking about the Treasurer's announcements.
Hi, yes, so there was another further Treasurer's announcement on the 24th of April, which aimed to clarify some points. And these changes aren't yet legislated, but it has been flagged that they will be put into the legislation shortly. So effectively, the announcement was that there is an alternative decline in turnover test now for special purpose service entities, which I'll touch on in the next slide. The announcement allows for registered charity employers to elect to exclude government revenue from the turnover test. And there's going to be a clearer implementation of the one in all in principle. So this will be touched on further later on as well, but effectively it just means that if an employer is applying for the JobKeeper, they need to nominate each and every employee who was employed as of 1 March 2020, including those that were stood down during that time. They can't pick and choose who they nominate. They need to nominate everyone unless they believe that an employee wouldn't be eligible. So there were also...
Sorry to interrupt, Laura, but just to clarify that they have to nominate all eligible employees.
Yeah.
Yeah.
Yeah, unless they reasonably believe that they wouldn't be eligible, and that really only comes into play if the employee has advised that they've, for example, been nominated through a different employer. So that's an example of when you would know or not to nominate them. But otherwise, you would just send them out the nomination form anyway. So there are also changes to employee eligibility, but this mostly relates to full-time students aged 17 years or younger. So it's effectively, if they cannot establish that they are independent, they're excluded from the scheme, so they are not eligible. And then there were other changes relating to religious groups and universities, but we won't touch on that in this webinar. We don't believe it's probably relevant to the crowd. So the alternative test for service entities. This test will be relevant in circumstances where there is an employer entity who provides employee labour to a related entity, which is generating income for the group from unrelated third parties. So the entity generating the income may have experienced a downturn. However, the employer entity, obviously their income would have been stable. So in these cases, this service entity may be eligible for the JobKeeper scheme where the combined GST turnover of the entities falls below 30% or more, as per the basic test requirements, which Andrew explained earlier. Again, this isn't legislated yet, so we can't be certain of how exactly it will work. And there are a few issues which have been flagged already. One of the main ones is the fact that complex groups may not even be eligible under this arrangement. So for example, where one service entity is providing employees to multiple related entities, some of those entities may have experienced a downturn while others maybe even experienced an uplift. And in those circumstances, it will obviously dilute the loss which has occurred and the service entity may still not be eligible. So we would encourage you to seek advice if you do have a complex group structure like that. So the key elements of the scheme remain the same. Effectively, as I mentioned earlier, it's the one in all in principle. So anyone who was employed as of 1 March 2020, including those who were stood down, must be nominated if they're eligible. The employee must receive $1,500 gross, irrespective of their wage. So this means that all employees that you will be nominating, even if they're generally paid less, the employer would need to pay the difference, the uplift, the top up effectively, so that they...
To interrupt, sorry Laura, I've got a question from Rebecca. Just she wants some clarification from the service entity. So she's asked, Laura, can you give an example of the service entity? Is it labour hire and group training organisations? I wouldn't believe it would cover that, but have you come across anything, Laura, that would suggest that this is what that amendment has intended to cover?
Labour hire as in...
yeah, labour hire companies.
Yeah, so my understanding is that it's basically to do with the structure of your actual group. So if the service entity, for example, is providing all the labour to all the employees, to the entity that's generating the income, so the entity that's invoicing and etc., then that's where you could consider the group downturn.
Yeah, but I guess you touched upon it earlier by saying if it's a more complicated situation where you have one entity who are employing a group of employees who then are hired out to a range of different businesses, that's where it's going to be a lot more complicated, and we need to contemplate whether that actually would apply, because they might take that group as a whole. And the issue we have right now is that there's no legislation that's actually clarifying it. It's just merely an announcement. So we just don't know whether it's going to cover that or not. I would assume it won't, but that's just my assumption. So sorry to have interrupted, Laura. So you were just talking about the top-up payments.
Yeah, no, that's right. Yeah, so an employee can elect to participate. However, they cannot receive it from two different employers. So if you have an employee who works for two different entities, they will have to elect who they receive the JobKeeper through. It's important that employers understand that they must notify all employees in writing if they have elected to participate in the scheme, and within 7 days of giving the information to the commissioner, the employee needs to be notified so that they understand that the employer is nominating them for the scheme. So on your slide now is the form that we need to send around to each of the employees. So this is a nomination notice that if an entity was applying, you would send to each and every employee that was engaged as of 1 March 2020, and including those that were stood down. So this can be downloaded from the ATO website, and the link is on your slide.
Just a question come through from Barry. He said, if an employee resigned before the end of February and their last pay was the first week of March, am I right in saying they don't qualify and we don't have to count them in on the list? Yes, that's right. They don't qualify because you have to meet all of the limbs. So the first would be an eligible employee has to be employed as of 1 March, but then they also have to meet the wage condition of receiving the payments in on from the 30th of March. So that wouldn't be counted, even though they're theoretically been employed, they've been terminated, and therefore you don't have to count them. So on that point with eligible employees, so you have to be employed by the entity at the relevant time in the fortnight. So what this means is that during the relevant JobKeeper fortnight, they have to remain employed. So that addresses the answer to the question from Barry. If an employee is terminated in fortnight number 2, then you would notify the ATO that the employee is not eligible to receive the payment for the 3rd fortnight. So you can receive it for a fortnight if you were partially employed, but as long as you get the $1,500, you can get it. But the second, the subsequent fortnights, then you wouldn't receive the payment for the employee because they've been terminated. And this, merely by being eligible for JobKeeper, doesn't mean you have to keep employees on indefinitely. If there are performance issues or something else that warrants a termination, then you can still contemplate termination. But overall, the intention of the scheme is to keep people employed, but not people who are poor performance, for example. A question from Melissa. Hi team, is the monthly income reporting picked up from a monthly BAS lodgement, or are we required to report to a separate portal? I don't know the answer to that because actually our accountant's the one that kind of knows the details of these kind of things. So Andrew, have you come across this, whether you're having to report to a separate portal or is it just being picked up automatically from the ATO? No,
sorry, I'm not familiar with the hands-on requirements to actually lodge it.
Yeah, sorry, Melissa. I don't know the specifics about how you actually go about with that, but the ATO will have some guidance on their website. Otherwise, speak to an accountant who might have some further information. If there's any accountants here on the panel, then feel free, and who know the answer to this, then feel free to give me a wave and we can take you off mute. Going to eligible employees, you have to be employed as of 1 March, as I mentioned, and you have to meet the other tests of being either full-time, part-time, over 16 years of age, although there are restrictions now with persons below 17 years. You have to show a financial independence if you want to qualify under 17 years of age. Casuals are eligible, but you have to be employed for over 12 months and on a regular and systematic basis, and you have to be an Australian resident. The exclusions are any employee who receives the paid parental or dad leave from the government. This doesn't include any paid leave from your employer, only the one that you receive from the government for maternity or paternity leave. Or you're also excluded if you're receiving workers' comp payments. Now, this is only if you're completely incapacitated to receiving the whole workers' comp payment. If you are otherwise getting a top-up from the employee because you're partially working, then different rules apply. But otherwise, if you are receiving workers' compensation, then you want to consider whether you're actually eligible or not. Then the actual JobKeeper payments, as Laura touched upon, you have to pay employees the full $1,500. This is inclusive of tax. So there will be an amount that's withheld from tax, but it's not inclusive of superannuation. So with superannuation, you're only required to pay super on the amounts that the employee works. So if you have an employee who has otherwise been stood down and you're still making their JobKeeper payments, but they're working 0 hours, then you don't have to make any superannuation contributions. It's really just whether the employer elects to do it or not. It's at their discretion. But if an employee is otherwise working any amount of hours, then they have to be paid their superannuation and other entitlements on top of it. So you just work it out based on your regular entitlements. It's also really important to understand too that you can't reduce somebody's hourly rate, and Joey is going to be talking about that a little bit later. So if you're receiving less than the 1,500, then you have to do the top up. So this is going to be relevant, particularly for the payback period for April. If people who intend to apply for the first 2 periods, you have to go back and pay all employees the $1,500 for those periods, even before you get the amount, as long as it's before the 8th of May. Question from Rebecca: if an employee is not working and receiving JobKeeper payments, do they accrue any annual leave entitlements during this time? Yes, you do. So Joey's going to be talking about that later on, about the application of the standing down direction. But yes, the answer is yes, you do continue to accrue leave entitlements. A question from Brenda: just wondering if Australian subsidiaries with only income from foreign parents and related entities are service-based as service fees based on cost plus service agreements. Sorry, I just need to read it. Just wondering if Australian subsidiaries with only income from foreign parent and related entities as service fees based on cost plus service agreements. Andrew, have you come across this? I guess it would be relevant for with respect to the GST turnover test, what GST you're claiming, and then the government wouldn't count any of the overseas derived revenue. Andrew, do you have any insight on that?
Oh no, that's what I was going to say too. I think I don't know it's not something I've looked at specifically, but I think the fact that overseas revenue is not counted could be fatal in that situation.
Yeah. Right. So, sorry, I've got another question coming from Brett. Are business owners able to ask employees to do tasks different to their job description? Yes, they are. You're entitled to ask your employees to do a task that's different as long as it meets certain criteria. And Joey's going to be talking about that a little bit later. But the answer is yes, but you have to follow a procedure. Going back to the JobKeeper payments, sorry, Brett, if you've got any other questions, just shoot them through, but Joey will get going a little bit more comprehensively into what the actual requirements are. Back to the JobKeeper payments, it's a reimbursement scheme that, as I mentioned, and if there's any change in the employment during that time, then you have to make sure you notify the ATO, such as if the employee resigns or they terminate. So business participants, Jacinta, this is what I was talking about earlier with you. You can nominate one business participant per entity, and this is where you have instances like sole traders where an individual is not necessarily employed, but they work on or in the business. It also includes partnerships, trusts, and it also applies to companies. So this is where you have a company who, you might have a shareholder who actually manages the operations, but is not otherwise an employee of the company. They still are eligible to receive the JobKeeper payment. Very clear, only one business participant is to receive it per entity. And where this might become a problem is with partnerships. Only one partner would be entitled to receive the business participant JobKeeper payment. So you're not automatically excluded by not being an employee, but you just need to see whether you fit into the category listed there. Other important points to note is that the first payments are coming out on the first week of May. I was told they were coming out from 1 May, so it should be any day now. There are reporting obligations too. You have to notify employees. Laura mentioned earlier, you have to notify them of an intention to apply, as well as once you've actually made the application. And also there's obligations to keep a record. So you have to keep them for at least 5 years, and so that when the ATO does the audit, then you have them readily available. Now, if there are any kind of disputes, then there are mechanisms that you can dispute a decision from the ATO. This is where you'd be wanting to get some advice about the merits of your claim and whether there's reasonable prospects of success. But the point to take away from there is don't automatically assume if you're rejected that the ATO is right about it. There's things you can do in order to challenge that. Now, I'm going to pass over to Joey, who'll touch upon the question that you just asked, Brett, about the JobKeeper enabling direction.
So the Fair Work Act, hi guys. So the Fair Work Act has implemented some temporary changes in light of the coronavirus pandemic. So specifically in relation to the Fair Work Act, they've authorised, so they've done this thing where they've, it's called JobKeeper Enabling Directions. And in essence, before any employer can take these sort of directions, the first thing is they need to be eligible and receiving the JobKeeper payment scheme. So if you are part of that scheme and receiving those payments, and effectively it authorises an employer who qualifies for this scheme to give a JobKeeper enabling direction, which allows variations to various things, which can include reducing hours, although the hourly rate cannot be reduced. It has to be the same, but you can reduce, you know, if you've got an employee who's on, you know, 8 hours a day or something, you can reduce it to 4 hours potentially. So it also can vary duties, the location where an employee normally works, days or times when the employees perform the work, and also the employee taking annual leave. So these are called JobKeeper enabling directions. There are obligations where you're required to consult between the employees required to consult and provide an intention of the proposed variation. It needs to be 3 days notice, and then there needs to be a consultation about it, and there needs to be an agreement between the employer and the employee. Now, an example in relation to the duties to be performed, just one I can think of is if there's, you know, if Bob owns a restaurant and has been required essentially to close down that restaurant because of the coronavirus, and then he instead elects to do a takeaway service, he can essentially get one of his waiters to do deliveries, for example. You know, you know, waiters' duties have been changed in response to this coronavirus pandemic, where normally, you know, instead of them waiting and serving people at the shop, he's been directed. Obviously, there needs to be an agreement, but he's been directed to do delivery services and providing these foods to people's houses. That's one example. Now, once a JobKeeper enabling direction is given and there's a consultation period, it cannot be unreasonable in the circumstances, and it must be done for an employer who has reason to believe that direction is necessary to continue the employment of one or more of the employees. So this is the perfect example where in the example that I gave in relation to Bob, if he doesn't give this direction and can't do takeaway deliveries, for example, then he may need to shut shop. So he's giving this direction to his employee in order to, because it's necessary for him to continue the employment of the said employees. Next slide, Sarah.
With the reasonableness as well, it has to be reasonable to specifically the employee. So for example, with Bob, the employee who he's directing to change their task would have to have a driver's license. That would be reasonable.
Yes.
Yeah. I mean, you have to kind of look at every circumstance.
Yeah. Yep. Next slide.
Sorry, I dropped the ball.
Right. So there's also in relation to, so first there's the enabling direction. There's also called the enabling stand down direction, which basically it's a provision which allows a qualifying employer to direct an eligible employee to work fewer hours, and in some circumstances, no hours, which effectively stands them down. Now, this is called, when they're stood down, this is called the JobKeeper enabling stand down directions, and employers can only give an employee an enabling stand down direction if the employee cannot be usefully employed for their normal days or hours because of the changes to the business that are attributed to two things. First of all, the coronavirus pandemic, or alternatively, any government initiatives to slow down the transmission of the coronavirus. So they're the sort of two limbs. So it's the typical thing that I've been getting from clients these days is if there's a slowdown in the business, a lot of employers, you know, try to seek or justify standing down employees on that basis. Now, I strongly caution against that. In my view, stand downs should be done as a last resort, and I would strongly recommend you seek some advice about that before doing so, because the rules don't allow you to stand down if there's been a slowdown in work. The stand down has to be, typically speaking, if it's out of the control of the employer, and the employee cannot be reasonably used or usefully employed within the business. So in addition to that, if you want to stand down an employee, you need to give them direction in writing, and the employee must consider the request and cannot unreasonably refuse the request. Now, during a stand down, the entitlements continue to accrue as if it had not been made. So your personal leave, long service leave, and the like continue to accrue as per what the agreement was initially before standing down on less duties.
So I've got a question from Sonia. She says, I see that an employer is permitted to reduce hours for an employee, but can an employee refuse to work some hours? The answer to that really depends upon what the original agreement was with the employee, so what the employment agreement contains. For example, if you've got a casual employee who had agreed to work 20 hours per week, it could have been different days, but as long as they've agreed to work 20 hours per week, and then the business closed for a period of time, and they were stood down, once JobKeeper comes back, the business might then intend to then open the store, even if it's got less customers, and then require the casual to come back and work. That casual cannot refuse to work less than 20 hours and still receive the JobKeeper payment. That's not right. But as against that, the employer can't require the employee to work more than the 20 hours unless it's agreed. So you have to really go back to the original employment agreement between the employer and the employee to see what that states. And you can't really amend that just because of the JobKeeper payments unless unless the enabling direction has been issued, and then that's when you meet the criteria. Is that what you'd be assessing as well, Joey?
Yeah, that's my understanding. Also, on top of that, essentially, an employer needs to ensure that the stand down directions and the change in hours is also, it can't be unreasonable. So taking into account the circumstances of the employee. So, for example, if the employee has caring responsibilities and things like that, they need to take, it's on a case-by-case basis. They need to assess each employee's personal circumstances when giving the direction. Now, any direction which is unreasonable technically doesn't apply. I mean, there are mechanisms of fair work for disputes and things like that if these situations arise.
Yeah, I guess it's a good point that you've made, Sonia, because I have read a few articles about employees suggesting that they don't want to go back to work. They want to keep getting JobKeeper payments. And that's not what the Act intends. It really is intended to keep people working. And so it's not unreasonable to require employees to go back and actually work the hours that they're otherwise working. But it has to kind of go both ways. You cannot exploit employees and require them to work more than they otherwise did, to work up to the $1,500 unless it's agreed. And likewise, employees have to still meet their obligations. Now, this is what I mentioned at the start as well. You can still performance manage employees if they're not satisfying the employment conditions and they're not meeting expectations, then you follow the same rules that otherwise would apply with respect to in managing employees.
Yep.
And Joey's going to talk about that a bit.
And the final thing, just in relation to the stand down, is in circumstances where employees are subject to JobKeeper enabling stand down directions, an employee can request secondary employment or alternatively training or professional development in the circumstances. Now, employers must consider these and must not unreasonably refuse these requests. And further on in relation to the awards on the next slide, basically what the Fair Work Act has done, the Fair Work Commission has done, is in light of the impact experience on their own accord, there's a provision which allows them to do so. They've initiated temporary amendments to numerous awards. So it was 3 or so awards which were initially changed, and in light of this, the Fair Work Act, the Fair Work Commission, on its own accord, changed 99 additional awards. Now, you can go on the Fair Work Commission page and have a look at if you have any, if you're an employee subject to an award, or an employer who has employees on certain awards, you can have a look at these changes. But in a nutshell, what's happened is the amendments are in relation to unpaid pandemic leave and annual leave. Now, basically, it allows employees who are employed under one of the affected awards 2 weeks unpaid pandemic leave, or alternatively more if there is an agreement between the employee and the employer. But it's relevant to note they're allowed this unpaid pandemic leave if the employee is prevented from working as a result of being required to self-isolate by government or medical authorities, or acting on the advice of a medical practitioner, or by measures taken by the government or medical authorities in response to the pandemic. If there's a shutdown, if there's, for example, at a school or something where there's a coronavirus outbreak, and then the government shuts down that school, then in those circumstances, for example, if any employee is subject to an award, they can rely on this 2-week unpaid pandemic leave that they can take. Now, in addition to that, it doesn't have to accrue. It's 2 weeks. You don't have to work for a certain period to get this 2-week unpaid pandemic leave. And also, in addition to that, employees don't have to use all of their leave entitlements, such as if they want to access their long service leave or their annual leave. They don't have to finish that to then access this unpaid pandemic leave.
My understanding of it was it's really just giving some guidance to what would happen if somebody wants to self-isolate if they're otherwise at risk. Sorry to say, Joey, but Brett's got a question come through. Do you suggest providing a new employee agreement to establish some new KPIs or performance requirements during this period? If employees are asked to do different tasks, the assessment of their performance will need to be against new KPIs rather than previous KPIs. Just going back to the requirements of the directions, they only to apply until the 28th of September. So effectively, if you're going to be changing somebody's position long term, you're going to need to be having agreement with the employer about that. And that might be occurring lately because businesses are changing how they're operating. So you want to follow the proper procedure with respect to that, but not necessarily having regard to this specific legislation, but just having discussions with the employees about how the business is going to go long term. If you reach an agreement, then 100% you should have a new employee agreement, or you want to have an amendment to an agreement and make sure that it's really clear what the KPIs are. You might already have some policies and procedures in place that you might want to update as well, and often that doesn't require entering into a new agreement if you've had it properly drafted. You want to just then be updating those policies and procedures. So definitely have regard to what the actual instruments are saying governing the employee relationship. But with respect to those specific tasks just during this period, I wouldn't necessarily spend the time having to go through in too much detail because it's only for a temporary amount of time. Sorry, Joe, you were just getting to, sorry, you're on to the next slide.
Yeah, and the last thing in relation to annual leave is it allows an eligible employee to take paid annual leave at half their rate. So effectively, half their rate for double the period. Now, just important things to remember, the Fair Work Act still applies. So in times like this, you have to be careful before you terminate someone, whether, you want to rely on redundancy provisions or poor performance or things like that. The Fair Work Act still applies, and companies need to be careful before they make any rash decisions because potential claims can be made. Now, there's on top of that, there's ongoing fiduciary obligations that must be upheld. So employees need to act in good faith, protect their employees' interests, not make secret profits at the employee's expense. So these things are relevant in circumstances where everyone is working from home, for example, where they may have access to confidential information of the employer. So in times like this, it's just important for an employer to be transparent and communicate to their employees of their ongoing fiduciary obligations during this time where people, for example, may be working from home.
There's a question coming through from Brenda that you might want to address because it touched upon your previous comments. Can employer ask their employees to take 1 week unpaid leave in each of June, September and December 2020 quarters as cost-cutting measures in the pandemic?
Sorry, just one sec.
Oh, sorry. While you're having a read of that, my answer would be yes, you can ask, but if they don't agree, then you can't be forcing them to take unpaid leave, unless. So you effectively need consent.
You need agreement. There needs to be an agreement. That's the number one thing.
But otherwise, you can force employees to take leave, annual leave, provided you make the proper direction.
And there's a 2-week balance.
That's right. That's right. You have to leave a 2-week balance. Yeah. But in terms of unpaid leave, it would have to be with their consent. And otherwise, the only way that you would be able to not pay employees for a period is if you were standing them down. And if you've only otherwise had a decline in revenue, you wouldn't be able to meet that test. You could otherwise stand them down under the JobKeeper, the JobKeeper rules that Joey just explained, but it would have to be after consultation and effectively agreement. So you have to get them to effectively consent to it.
Yep. And also during this time, especially when people are working from home, an employer has obligations on their employees, such as to provide a safe working environment, even if it's from home. And there are potential workers' comp implications in this regard. And I understand we've got a working from home policy, which we've provided to our clients for free, so you can access that on our.
You drafted to.
I did. And that's on our website. But it's important for employers to understand that just because people are working from home, then there is still a risk there of workers' comp claims and things like that, and they need to maintain a safe working environment as practically and reasonably as possible.
Yeah, and we're actually going to be doing some other webinars on employee-employer relationship, particularly not having regard to JobKeeper. So people who don't qualify, what are the obligations? Thinking about working from home and what security and expectations you can still require your employees to meet, and how businesses might be changing and evolving. So we want to make sure that employees are going to be aware of what those obligations are. Sorry, Paul, I saw a question from you through the chat. I'm really sorry I missed that, but he asked, what would happen if your accountant confirms that you are eligible for JobKeeper, but they have included overseas monies that were not GST? Who would be liable if they don't give or decide later you have to pay back the JobKeeper? That's an interesting question. I guess you would have to firstly look at what advice you're getting from the accountant and whether they have properly applied the GST turnover test. If there has been some kind of negligence on their part, so they haven't properly considered the circumstances, then you might potentially be entitled to pursue a claim, but that you would first have to have some damages in order to recover that. So, but in terms of paying it back, then the obligation would be on the entity who's received it to pay it back, not necessarily the accountant. But so in that instance, the ATO would require the entity to pay it back, and then if there's any loss arising from that, you would contemplate a claim against the accountant in that instance. But it would be potentially a bit of a difficult claim to establish because the accountant would be relying upon information from the entity. So it's a bit of a tricky one. So you do have to be very careful about this and make sure that you're getting some proper advice, but that depends upon how the company's been set up. Andrew, is there anything you wanted to weigh in on that question?
No, well, obviously it's a fair bit out of the scope of this discussion, but one thing that you would have to consider in such a situation is whether you've actually incurred a loss. In other words, if you've claimed JobKeeper and it turned out that you weren't entitled to it, and there's an allegation of negligence, you'd have to consider whether you're actually any worse off because of that. You had money which you then had to pay back. I mean, one answer may be if you've kept people employed who you wouldn't have otherwise kept employed, then you might be able to say that you have suffered a loss. Yeah,
that's what I was just going to say. The only way I could conceive of a loss is if you either stood people down or otherwise would have made them redundant, then that would be potentially a loss. I've got a question from Julie. Hi, Sarah. Back to an earlier question, just to confirm, with relation to sole trader who also has part-time employment elsewhere, sole trader would be eligible for JobKeeper, assuming tests are met, provided they are not nominated as receiving JobKeeper from their part-time employer. I previously listened to this. If a sole trader had other employment, they were not eligible. Yeah, that's right. You can only receive it from one entity. So that sole trader would not be able to receive it under their own business, so the entity with the ABN, if they're also getting it from their part-time employer. So you have to elect one or the other. And this is where it comes back. I'm just going to slide through quickly. And Laura talked about the JobKeeper employee nomination form. You have to have all of your eligible employees complete this form and keep a copy of it at your business. And on this form, the employee nominates whether they're actually getting it from somewhere else. So if they are, then you can't seek JobKeeper from them under your business. So this is why this form is very important. Now, if your employee is otherwise being dishonest and they put yes to both, then I don't know what will occur, but I expect that there would be less culpability because your employee is being dishonest. But otherwise, if your employee says, I'm getting it from somewhere else, then you otherwise still apply for them, then you're going to be having to pay it back, and there's potentially some penalties and fines imposed with that. So make sure that this form is properly completed and you're giving employees the information that they need. There are some really good resources, including you can ask us, but otherwise there are some resources available where you can get some templates for letters that you're giving employees, giving them notice of the intention to apply. And then also I touched upon the notice employees within 7 days after you actually have applied. So if you're following these proper procedures, then the government's going to see that you've done everything you genuinely can do to make sure that you're not otherwise breaching the Act and the rules. And in that instance, I expect any penalties wouldn't be imposed, and otherwise you'd just be paying it back. But if otherwise you're doing something to try and achieve more money than otherwise you'd be entitled to, then that's when there's going to be some penalties. So very clearly, you can only get it from one entity. Also, with touching upon everyone is going to be included. The government's also said that if you have terminated any employee after 1 March, so if they were employed as of 1 March but otherwise have been terminated, you can reinstate them and apply for them and apply to receive JobKeeper for them, provided they otherwise meet the same test. But we spoke about this last time, and Joey had some really good points that he made about just being a little bit cautious if you're reinstating employees you've made redundant, because otherwise it might demonstrate that it wasn't a genuine redundancy. We are going to be talking about redundancy at a later webinar about how you could potentially, terminating an employee, how redundancy could be classified. You can seek, if you're a small business, to try and get redundancy waived, and also ways in which you can contemplate termination of employees, but we'll address it later. But if there's any questions now, I'm happy to.
Just one thing, it got touched on last week in relation to the entitlements that are paid. So if an employer makes someone redundant or terminates them, whether they rehire them, whether they're able to claw back any notice periods or redundancy pay and the like, the short answer to that is no. That's an entitlement under statute for the employee that get paid these entitlements. But in relation to whether there's any continuous service of employment, the short answer for that is also no, but in some industries there are a continuous period of service, such as for long service leave and things like that in certain industries, subject to if a criteria is met, such as if they're terminated but then they come back within the same business for 3 months, within 3 months, for example.
Yeah, so you want to be thinking really carefully if you're going to be bringing employees back. They might have been a great employee and by all means great, but just make sure you're contemplating how then they're going to be re-employed in those terms.
Yep.
No more questions coming through. I hope that we've covered everything any inquiries that you've had, and we've covered all of the broader pictures. It is relatively new legislation. The Fair Work have just recently brought out a bench book with some guidance on it, so we're going to be looking into it more. We have a lot of resources available through our website and also through our notice boards, which we send out weekly, to try and keep everyone informed, particularly about employees. That's one of the biggest discussions going around at the moment. So if you have any questions later on following this, then please get in touch with us. We're happy to answer any questions. We really want to make ourselves available to our clients and our community to make sure we're helping everyone through this pandemic. But otherwise, we'll leave it here, and we hope to see you at the next one. The next seminar will be next Friday as well, and at the same time at noon, and it's going to be on the topic of the mandatory code of conduct for commercial tenancies. So this is if you rent any commercial or retail space and you want to try and get some rent relief, then we'll talk about what the obligations from both sides are. So we're going to be looking at both the tenant perspective as well as the landlord perspective. So Andrew's going to be hosting that one, and we also got Marissa Kindred and Tanya Schiff, who are coming along as panellists. and we're happy to answer any questions as well. And hopefully you can make it there, but otherwise all of these sessions are recorded so you can view them later on. But thanks for joining us today. Hope everyone has a great weekend and enjoy the two-person visit rule that now it apparently applies from today. I'm really excited about that myself. So hopefully everyone has a really nice weekend socialising with only two people, no more than that. All right, guys, thanks very much. I'm going to close it off now. Thanks, guys.